started. So we started REDTalks back in Ithaca during our summer, and we have had successful events running there with multiple speakers from within the cohort as well as from outside coming in and speaking to students about how the industry is growing, like fintech as well as like technology within the emerging markets. And we with this event, we are now starting REDTalks in Cornell Tech, and we have an interesting lineup of speakers today. Thanks to Lotus for connecting all of us. And I would like to first call upon Mr. Amarildo. He is the head of Harness Financial, building value-added products for consumers designed to provide card spend, engagement, and retention. Mr. Amarildo is a Cornell Tech alum and an EMI fellow in the past. He is a current visiting faculty for the Business Fundamentals course here. He is also an adjunct professor for Information Technology and Business Strategy courses at Barrett College and teaches data product design at Yeshiva University as well. So I would like to now call upon Mr. Amarildo.
Perfect. Nice to meet you guys. Technology, innovation, all that fun stuff. So I'll do a quick background on me, all that fun stuff, and then we'll go into some of the EMI components. I have hardcore ADHD, so I like to try to get my hands on everything. Undergrad finance, MBA here at Johnson. My work was a couple of companies, did go-to-market strategy, big pharma. So launching new molecules, your typical, how do we make money in the 10 years we have to make money? I spent about 7 years at Mastercard across corp dev, strategy, M&A, capital investments, global strategy. Pretty much anything involving strategy I've touched in one form or another. About 6 months ago, I shifted over to Harness, which is one of my customers, and we build bank products. So with Harness, I lead the financial services practice. So I have sales, engineering, product development, pretty much all the way through from product build to getting it into market and delivery. I teach here. I teach business fundamentals, so all the technical students that you guys are going to be taking classes with. I had a bunch of them in my classes over the past 2 months at 8:20 in the morning. So imagine a bunch of 22-year-olds trying to make it into an 8:20 a.m. class. It's a blast. I teach MBA at Baruch, and I teach computer science at Yeshiva. Basically try to fill out my day as much as humanly possible. Born in Albania, raised in America, worked in a bunch of different countries in terms of work. Most of my time living was in the US, but spent time working across on projects globally just by the nature of Mastercard being in 90 countries with offices at 180, 90 countries. Harness, where I'm at now, we're mostly US based right now, but we're figuring out what is the first region we want to expand to from an international perspective. Everyone says lean toward Europe, but we're going to talk about regulation and some of the major issues with Europe as well. And there's a lot of them. But to be fair, at this point in time, what country doesn't have issues? And what region in the world? Quick background on me. So the topic is regulation versus innovation versus regulation. Like what came first, the chicken or the egg? You have open banking, which to give a quick high level overview of what open banking is, every single one of you has a checking account, a debit account, a credit account, so on. When you go to a bank and you have your checking account with them, in the old world, they owned you as a customer. If anybody wanted to touch your money, they had to go through the bank. If you wanted to work with anyone, they had to go through the bank. With global open banking now, that DDA and that direct deposit account that's your money, you can go to a fintech and say, you know what, I want you guys to do my general ledger. I want you to do my budget for my house. I want to move money to somebody else. It's opening that bank account to other people to be able to do stuff with. Open banking is a really interesting example of regulation. So there's a bunch of parts of the world where this is being led by the market. The market is going in and saying, we need you to open this so we can build better products because the consumers demand better products. That's how it's being led in the US. And think of Plaid, Finicity, these companies that are stepping into open banking. In other parts of the world, regulation is coming in and saying, you will open up the account, you will give these KPIs, and you will set up these APIs in which everyone is able to call from, and we will set up a bare bones basic level of understanding in which everyone must have. If you're a bank, you have to have these open so everyone can connect. This is the world of banking. A lot of this is the B2B and the enterprise side. What works and what doesn't is still up for debate. You have parts of the world that are saying, you know what, we want our regulators to make business easier. However, as we're going to give a couple of examples, business is not known for having the best ethics. Like child labor laws exist because businesses are terrible at making ethical decisions. Human trafficking laws exist because businesses are terrible at making human ethical decisions. So what is the threshold of where can you regulate something to actually champion innovation without strangling the technology? From the open banking side, that's just one example. Airline industry, production, manufacturing. There's so many industries that have gotten a lot easier with regulation, and there's so many industries that you're seeing people get innovation get choked out as well. So if you think of the world broken up into a couple of economic blocks, you have like the US and Canada, you have the Chinese sphere of influence in the European Union. One of the arguments is the single biggest driver of innovation is American bankruptcy law. In the US, if you raise a bunch of capital, you light it on fire, as long as you do it ethically and in good faith, you don't owe that money back. In other parts of the world, you have your money is underwritten by you. If you raise company for your company and it goes bankrupt, it's your fault, your problem. That means that you can't do it again. That means you can't do it a second and a third and a fourth and a fifth time. Bankruptcy regulation is a massive upside in American business. It means that, like, Harness is VC backed. We raise a bunch of equity capital. If we lose and that goes away, great. We tried, we did everything we could, we wanted to succeed, we failed, you do it again. Other parts of the world, the founding team, the C-suite, they have personal responsibility for some of that. Individual wealth, America's extremely wealthy per capita. Capital markets and really sophisticated capital markets to be able to borrow, VC, private equity. Ability to cash out at any level, ability to actually draw out money. And last is, of course, the education system. America's pretty good at that. The bankruptcy regulation and all of these have the regulation that runs. We'll come to Europe, which is very different. China, massive market, increasing affluent population, tech innovation, manufacturing. But there's some really interesting protectionist policies that China has that if you're a Chinese fintech or a Chinese company are really helpful to you. The technology sharing, where if you're trying to do business, the Chinese company has to own 51%. The information moving over, you're effectively trading technology for market share. That equation over the past 2 to 3 years, 5 years has changed, where you're trading technology and not getting that market share in some industries. But that worked incredibly, incredibly well for quite a bit of time. Right now, we're starting to see that shift. So if we think about America, large, wealthy, 300 million consumers. China, 1.x billion consumers, growing affluent base, large market. If you're international, you can grow in China on paper. Europe is bubblegum and scotch tape of 30 countries that in and of themselves aren't that big. However, what I would argue Europe has better than anyone and any other entity on earth is a regulatory body. America can market demand products. Europe can dictate rules that the rest of the world follows, or you lose access to the European market. Less than 48 hours ago, they announced that all phone chargers will be the same. I can't fathom the US government dictating something like that to business. Brazil is doing this as well with phone chargers. That's a really simple one that we see as consumers and we're like, oh, we get it. But think of all the other regulation that's happening on the back end that if you're not in that industry, you don't know, you don't understand, because you just don't deal with it. Your average American merchant spends 7 times more than your average European merchant to accept the exact same credit card and debit card. That delta is 7x. That's European regulation in and of itself. GDPR. GDPR is the gold standard in data. The jury's out on the success of it because it is making some business harder. It's increasing the barrier to entry for others. But Canada's copying it, Brazil is copying it, and it's setting a world standard now because you're not just going to bifurcate Europe and be like, you know what, we're going to do one thing here and we're not going to do it in all the rest of the world. Car production, emissions, Europe sets standards and the rest of the world follows based on their sheer size. America dictates on wealth and capital, China dictates on size of market and penetration, and Europe dictates on pure regulation. Standard EU market, it's literally called the standard EU market. It's you agree by our rules and you get access to all of these countries. You don't agree by our rules and you get access to none. Pretty smart at the end of the day. Another thing I tried to compare this, and my European friends hated it. It's like the European approach is like living life with training wheels. Incredibly good for the quality of life of your average everyday population. Brilliant, great employee protection laws, great consumer protection laws, great rent protection laws. However, if you're trying to build a startup, Europe is awful. Awful is an understatement. It's probably worse than awful. My clicker stopped working. No, it's my clicker. Okay. Why is Europe awesome? If we think about it, 1,100 unicorns right now. China has US has 600, China has 175, India has 65. All of the European Union combined has 81. And I've had a lot of drunken stooger conversations with European colleagues and classmates. And the gist of it is right now at Harness, if we raise a B round, we go out and hire 50 people. And what we're doing doesn't work. We pivot the company. We have to lay some off. We repurpose some. We keep growing and keep going. If I get that wrong in Europe, we can't lay 50 off. The whole company burns. European regulation around employment law is just one caveat. If I get rid of somebody in Belgium and I have another job open, they're the first ones I have to consider. France, with international companies outside of French companies, think of the number of companies that have headcount in France. I'm telling you, it's quite limited. European regulation works incredibly well from a training wheel perspective, but from an innovation and technology perspective, this strangles technology. If you get something wrong the first time, you don't have the chance to pivot the second, the third, the fourth, the fifth, which is where you're seeing companies in Europe, I'm sorry, not in Europe, in India, in China, in the US grow. But again, amazing for quality of life and the standard of the population. So the Walmart has a really cool concept. It's like called an 8-box, where you have 8 different business lines. One person's job is to be the business. My job is not to have ethics. My job is to be the business. There's an ethical person and a lawyer person, a regulatory and a product. But from a regulation perspective, is critical. However, when it starts to strangle innovation, that's when you're starting to see a major impact on society. Because can you name 10 European startups that are a billion or IPO? One of the most successful ones was Wirecard, and we saw how well that worked out. So if we think about that's regulation leading to innovation, let's go the other way around. What's happening in the world of Bitcoin and crypto right now, and that implosion? This is a scenario now where the regulators around the world got caught on the back heel and got absolutely punched in the face. The American approach of regulation is I'm going to wait until consumers get hurt, and then I'm going to step in. The European approach of it is I'm going to step in before I think consumers are going to get hurt. You had a bunch of these crypto companies raising money being like, we're not a bank. And then they go bankrupt and they go to a bank. And you're like, wait, you can't not be a bank and have the same American regulation and protections. An FDIC insurance account exists to protect the end consumer and their deposits. Those doesn't exist in crypto. When you borrow or lend to a crypto company, you're giving them your crypto. You have no recourse. American regulators got caught on the back heel. And by the nature of how US regulates, this is where it went south. And there's a lot of people that have lost a lot of money. However, your average everyday consumer still hasn't felt the massive pain of it yet. Why and where can emerging markets learn from this? This is the Triangle Shirt Fire Factory. And this is a photo from the 1997 Albanian Civil War. Do you know what caused the Albanian Civil War in 97? A pyramid scheme. A pyramid scheme led to the death of a couple thousand people, in which the government was, one, dumb, but two, a pyramid scheme led to a civil war in a European country. Think about that for a second. If consumers and if companies are allowed to do whatever they want, you have hundreds of people locked up in a factory on fire, and you have civil wars and strife. So you can't let business dictate terms. There is a happy medium here of where do you regulate to open up certain industries, but at the same time, how do you not let owners tie up employees in factories? How do you not let there's a reason why child employment law exists, is because if CEOs could get away with it, they still would. There's a reason why minimum wage exists, because if people can get away with it, they would. The protect shareholder value and investment. So where is that middle ground? And that's the question that every single country on earth has to answer, is where how do I stop myself from overregulating? Do I want to create a base of the pyramid, the American approach of we're going to do everything we can to not let people starve, but our single goal is to protect the country and give everyone the sandbox that best and grow and build? Or do I take the European approach of we're going to do everything we can to increase the median quality of life, but it's going to cost us on both ends of the extreme? Europe has taken the approach of we're chasing after a strong, healthy median. You're seeing different parts of the world, China, India, US, that are going and chasing after the extremes in the whole economics of trickle-down economics. We're not going to get into what is a better economic policy, but it depends on where you are and what you're doing. A bunch of us here are mobile. If I was working at a fintech, I would not be working at a fintech in Germany. If I were married with 3 kids and wanted a White House and a picket fence, my quality of life in Germany would be better than almost anywhere else in the US. However, it depends on what you want to do, and it depends on what your government is optimizing for. The German red tape, if anybody's ever dealt with it, is soul crushing. Think about, like, you guys have dealt with Cornell. The bureaucracy is not too bad. Imagine that on like steroids. Why can't you do this? Because the paper says no. Why does the paper say no? I don't know. The person who wrote it died 40 years ago. It's really different. That's the overregulation side. A couple last things I want to talk about is speed of regulation. There's a lot of companies that got caught on the back heel of crypto. Regulators still haven't fully caught up. That's happening in securities, that has happened in private markets. If you look at all the dark pool stuff that happened with Robinhood and Citadel, there's different regulation around the EU, specifically that the UK is not a part of now in terms of securities law. Speed of regulators aren't affecting it. And another big issue here is it's a rotating wheel of people in high finance roles are now the regulators of high finance jobs. People in tech are now regulating tech. People in auto are now regulating auto. It's that whole spinning wheel concept. It's also the speed of addressing these changes. And lastly, what this does is it creates a massive amount of uncertainty. I don't like uncertainty. You don't like uncertainty. Capital markets don't like uncertainty. No one likes uncertainty. You're seeing different countries flip-flop on concepts, on policies, and those are the ones lacking that aren't getting the capital investment right now. If when I'm working with a country, my previous role, when we were working with governments, and the government flip-flops, you're allowed to do that once or twice before I'm like, yeah, this isn't worth our time. Why are we going to open up an office or put a multi-year capital investment when we're one regime change away from losing all of it? When we're one access point away versus, hey, no matter what, and this is what Russia up until this point did, is no matter what, the oil kept flowing, the gas kept flowing. Throughout all of the Cold War, throughout the Cuban Missile Crisis, the gas kept flowing. That dynamic changed. There's now uncertainty in that game, in Europe energy. When that uncertainty is built in, people start to optimize against it. Every single one of you has dealt with some version of optimization. As MBAs, we love to optimize things, even to the point it's detrimental to us. But when it comes to this core regulation itself, where is that line in what you're doing? This is now that, that's that up. This is now where we're starting to see the world trying to figure this out. And these are where you're going to start to see companies and countries as a whole do incredibly well. UK figured it out with neobanking. Look where some of the biggest neobanks on earth are. The UK before this took 6, 7, 8 weeks to open a bank account. I would guess, if I had to put a hypothesis, I would say some of the global innovation here is not going to come out of your BRICS countries. It's not going to come out of America or China or India over the next 20 years. It's going to come out of the parts of Africa that are getting ahead of this, where the regulators are working with business. It's going to come out of the Pacific countries, where the regulators are coming in and saying, what can we do to make life easy? What can we do to get this out there? With, of course, making sure that employees don't get locked up in factories. This is going to be an exciting topic over the next few years, but at the same time, when it goes south, countries get invaded, so we'll see. But happy to sit down and chat through questions with folks after. Now on to the next. Let me fix this while I'm here.
Thank you so much, Mr. Amarildo, for that. So we'll save questions for the end once all the speakers have gone. So our next speaker is Dennis Huang. He is currently an executive vice president in Bank of China here in the US. He's in charge of the bank's US corporate strategy, research, and senior executive training programs. He's leading his team to develop the risk-based strategic plan for the CEO of Bank of China US Securities. Before working for Bank of China, he has extensive experience in the securities industry in both China and the US, and he was one of the pioneer members in 1989 who did foundational work for the Shenzhen Stock Exchange. He's also Cornell Johnson alum and has received a certificate from NYU and also another certificate from Huang. Thank you. And let's welcome.
First of all, I would especially thanks to the audience. We're very good friends for a long time. Yeah, today actually, like first professor focusing on the regulation for the technologies in the financial industries. So I'll be more focused on the fintechs in China. So I'm also the vice board member for the EMI. So I want to share our observations on the fintech in China's markets. So first of all, let me this one. Yeah, first of all, let me just give you I think the fintech. There's a lot of discussion about the fintech. So what's the definition? What's the concept of fintech? Actually, there's a very standard definition criteria from we call financial stability board. It says fintech is kind of technology, but lead an innovation which will create the new business model, new processes, and new services. So it's the fintech to the financial service industry, of course. So the key words here for fintechs will create innovation. For the financial industry itself, it will especially will enhance the efficiency, right, by the multiple ways. So maybe later on, maybe I'd love to compare the Japanese quality management to the fintech. So the difference is very dramatic because the fintech really brings the disruption rather than just quality control itself. And so if you look at the Chinese landscape, I would like to give you the high level. The landscape in the Chinese markets. So basically, there's several players in this market. First of all, is we call the central bank affiliates. The other one is more like commercial bank subsidiaries, just like Bank of China and the other commercial bank. We have built our own financial fintech subsidiaries. But the third one you must be very familiar with is big tech, like Tencent, like Alibaba. They also own financial subsidiaries as well. And then we have an independent technology, fintech technology, like startup, all those independent. So the focus actually for those different players are different, right? So basically, for the central bank, like PBOC, their focus is more on how to improve the regulation, improve the infrastructures, improve all those kind of big stuff, right? So, and for the commercial banking like ourselves, so maybe not only we'll be more focused on digitalization transformation because we have a lot of legacy, right, in our system. So we need to innovate it, to invite more disruptions and invite more digital transformation. So that's the main purpose for this work. And for the big tech, big tech is mainly because of the recent development, especially for the emerging technologies. We're going to mention later on. So they are inviting a lot of fintech activities related to this big techs. Of course, we have all the innovation from the startup, all those capital raising on independent companies as well. So that's the key framework actually for the. Of course, and besides those main players, all the commercial banks ourselves, we also have embedded financial technologies into the different business lines. I give an example from this chart. Actually, you can see that on the left side is on the focus on the commercial banks application of those fintech technology. So basically, we have two categories fintech application. One is on the balance sheet business. Balance sheet business, as you know that, right? On the asset side, we usually have a lending, like loans, like whereas on the liability side, we have deposits, right? But this fintech technology help us to enhance our interest income. On the other side, we also have fee-driven income. For example, we have an investment-related fintech activities, and then we have wealth management and all those compliance, all those related activities. And basically for the commercial banks, we try to integrate the fintech into our legacy system. So that's very challenging because first of all, we need the digital transformation first, and then we can apply the new emerging technologies into our banks. But for the large tech, fintech, they are much easier because they don't have like historical burden. They don't have a lot of legacy like Alibaba, like Tencent. They can directly organize, the activity, fintech activity around some key core activities, such as payments, such as other affiliate activities. So it's much easier on the financial, on the right side, to bundle all the products, with tech than traditional bank like us. And so let's move to the next page. Let me show you the landscape of the fintech in Chinese bank industry. So if you have, first of all, if you look at the spending recent year, that's actually the ranking, right, for the investment amounts. So if you see that, you can see the big six state-owned banks from ICBC all the way down. And then on the last row, I also list one of the biggest, I would say biggest shareholding bank, we call it commercial merchant bank, right, CMB. So that's basically we see that's a ranking right now on the for the Chinese banking industry. And if you look at the fintech business case focus, actually they have different focuses. On the technologies, if you see the technology, what they focus on, the largest portion have been the big data analytics, and then we have AI, and then the third one was cyber securities, cloud computing, and then we get RPA, so on and so forth. So that's the basic landscape right now in the Chinese fintech in the Chinese industry. And then let me just give a very brief idea of how the fintech industry evolved in China. So actually, if you look at the history, the involvement actually is very similar with the Western world. Basically from technology perspective, the history basically is the involvement of how electronic information, internet-based, and the new emerging technologies, right? So have empowered and centralized the banking industry. So that's the pathway. And then so for the fintech, I would like to focus the fintech here. Actually, fintech is unlike the internet finance stage. Fintech is more like on a broader sense. So in addition to internet technology, we have big data, we have blockchain, AI, security technology, Internet of Things, as well as the cloud computing. So but right now in our application, the most uses, like I just mentioned, that is the combination of AI and big data. They are widely used in the Chinese banking industry. And so the other thing I would say that the representative actually application will be mostly including the big data, credit investigation, intelligence investment, and supply chain finance. So those are the key areas for the AI and big data combination. So let me go deeper on the AI technology, because right now it's really, really hard. Because AI itself has 4 waves, as you know, right? The first wave is the internet AI, and then we have business AI, and then we have perception AI and autonomous AI. So if we talk about commercial banking AI, they are on the second wave. So Dr. Li Kaifu, maybe you know, Li Kaifu is a very famous AI specialist. He mentioned that financial industry and banking industry is the most suitable and the most potential industry application scenario for AI technologies. So I would say that AI will be the very important implication in the future as well. So, and then let me discuss a little bit about, because we mentioned about fintech is innovation, right? It's a kind of innovation to the product. So the question naturally becomes, what has fintech disrupted? What have disrupted? So the disrupt, I would say that we observe actually the most things that they disrupt the core structure of financial business. So basically, they're going to significantly lower the cost to income ratio. As you know that the cost in income ratio in the banking industry also called efficiency ratio, right? So on the denominator, you have like a cost, especially technology cost and staffing cost. On the denominator, you have the operating income, right? So basically, if fintech significantly lower the denominator, right? Denominator. So that's where the disruption comes from. And then, so of course, like our first professor mentioned that when fintech really involved, you need to collaborate with the regulatory agency. As you heard a lot of stories recently about Alibaba, Tencent, they face a lot of challenges, from the regulatory side. If you read the story, that's what really happened in Chinese regulatory cycle in the financial industry. And then, so let me go a little bit detail what really, disruption happened. So basically, the fintech disruption financial industry from 3 perspectives, right? The first perspective is very simple, as you already know that it's a user experience or UX. So that's exactly happened to your daily life, right? You have like a cell phone, like a mobile phone, and they are the carriers to have this kind of experience. And then their experience is more like user-centric. When this AI developed for the UX, they especially focusing on the new generation of customers who growing up in the game scenario or in the in the social media scenario. So that's the scenario actually first happened to the AI. The second disruption is we call the long traditional digital financial services, right? So this become the core business of many fintech companies. The reason why we call the long traditional is that advance in the data science, technology, and cloud computing, machine learning, and other aspects has enabled long financial institutions to provide financial and digital services. The third aspect is financial infrastructure. That's more like a high level, or from the foundations of this FI, fintech scenario. So, for example, they include a bank payment system cross-border clearing, security and various financial asset transaction clearing system. All those systems actually put together. So if you look at this chart, very interesting. If you look at China versus the US, right? China's situation is like the three disruptions actually have been collected by the payment business. You know, if you look at the US, actually they are segregate each other, right? So the reason is that Mastercard, like a Visa, they have been the legacy in the US system for many years. So there's no emerging payment channel to really collect the points for the US. So that's kind of a very interesting differences among these three disruptions. And then the next one, the natural question will also be, so we already know what has been disrupted by the fintech, but what has not been interrupted. You have to think about what really is the essence of the financial industry. What's really essence of the banking industry? That's called regulation. That's called license. That's called the capital, requirement, right? So that's the essence. You never been changed. Even if you have those kind of emerging technology, even you have those fintech, we're going to really dramatically reduce the cost, efficiency ratio, right? So that's really the thing we did in our minds. Just like Alibaba, even thinking you bring a lot of disruption to this and bring a lot of customers to the market. But at the end of the day, you have to think about regulation, right? And also the essence of the financial industry. And then the last page, I would like to just show you, the comparison of China and the US, fintech. So according to the survey, right? So China banking industries prioritize several areas to apply the fintech to, including, for example, the online and chain finance. This chart already shown in the last pages. The mobile payment, big data, and AML. AML is the anti-money laundering, especially actually AML in the risk management and on the compliance areas. They have a huge like a rabbit tag, like all those apply in this area. And then for the US, actually, this chart actually showing the big three, like Goldman, Citi, JP Morgan, what they have spent the money in, right? What they focus have been the capital market, wealth, and the asset management, so on and so forth. So they have different focuses actually. Of course, these banks also spend a lot of money on the regulatory and compliance areas. As we know, just like our bank, we have like 25% of the employees in this area, and we spend a lot of capital in the compliance and risk area. So because of time limit, so I just want to give you a very high level landscape about fintech in China. Thank you very much.
For those insights in markets. And our next speaker is Mr. Peter Cornelius. He is a managing director at Alpenwest Partners, or the Carlyle Group, which is part of the investment solutions group of the Carlyle. At Alpenwest Partners, he is responsible for analyzing the economic and financial environment for private equity markets and examining the implication of the firm's strategic asset allocation. He served as the group chief economist at Royal Dutch Shell and as the chief economist and director of the World Economic Forum's Global Competitiveness Program. Prior to that, he was head of international economic research at Deutsche Bank and a senior economist with the IMF. Mr. Cornelius serves as the board of directors of the BGI Institute and is a research fellow of the EMI at Cornell. He also serves on the advisory board of the Private Capital Research Institute at Harvard. Mr. Cornelius studied at the London School of Economics and Political Science and received his doctorate in economics from the University of Göttingen. He has authored and co-authored several books, along with financing in entrepreneurship and innovation in emerging markets, along with Lourdes. So please welcome Mr. Peter Cornelius.
Pleasure to be here. Lourdes and I are actually teaching a course on entrepreneurial finance in the spring semester. So what you hear today is a kind of summary of that course. And now, the course is really about the dilemma a lot of countries face, but in particular emerging economies. The first observation, and that's an observation the Nobel Prize was awarded for, is that it's not enough to have capital and labor. When you go back to economic textbooks, the 1940s, early 1950s, the idea was you have more labor, you have more capital, and you generate more economic growth. That turned out to be misleading. Something else was happening. And Robert Solow from MIT, he is actually turning 100 now, discovered that this particular component that was missing in earlier textbooks is technology. There is no technology, there is no sustained economic growth. So where is technology coming from? That's a big question. Is this falling like manna from heaven? Probably not. It is embodied in human knowledge. That's why we're sitting here. This is why you are attending Cornell Tech, right? So that's endogenous force. And that's something Paul Romer discovered. He's now teaching at NYU. When he wrote these very influential papers, he was at Stanford. He was awarded the Nobel Prize for that particular theory, including endogenous force into standard OCU. Now, there's someone else who is currently teaching at Harvard Business School, Josh Lerner, and I'm working with Josh quite a bit. He discovered that most of the innovation is not taking place at large companies. We're not talking about the General Electrics, the IBMs, the Siemenses, or the Samsungs. Now, when you look at Samsung, you believe it's one of the most innovative companies on the planet, and that's true. But the most important innovations are actually coming from startups, right? And Cornell Tech is actually producing a disproportionately high number of startups. So bear this in mind, you are attending a university that's extremely innovative. Okay? So growth is actually tied to startups. The problem with startups, and we heard this in the first presentation, is money and a regulatory framework that's conducive to innovation. Right? The biggest problem is for startup entrepreneurs to fund themselves. So that's really the essence of the course Lourdes and I are teaching. So here you can see how countries have developed over time. We're talking about emerging economies here. So I index per capita income of the United States at 100. Now, here you can see Korea. Korea is gaining more and more momentum over time. Actually, Korea, back in the 1950s, was as poor as some of the poorest African countries. right? Korea has made very substantial progress over time. Now, there are a few other cases. Look at Brazil. Not much progress at all. Look at some African countries. Now, there's one country which doesn't appear here, but it's probably the most interesting textbook case. Can you imagine what kind of country is missing here?
Yeah.
Yeah, India is an obvious case, but it's relatively close to what you see here for China. But there's one country that has become a lot richer than the US. Exactly. Singapore is now, on a per capita basis, a lot richer than the US. That was not the case in the 1980s or 1990s. Right? So, let's see where this is coming from. These are the number of patents granted per 1 million people. Now, the color coding is not particularly good, but Korea, remember the previous slide, right? Look at what Korea is doing in terms of patents. It's the third most innovative country on earth, after Switzerland and Luxembourg, again, on a per capita basis. When you look at the absolute number of patents that are registered, clearly it is the United States, right? But on a per capita basis, Korea is highly innovative. Now, when we talk about entrepreneurship, I think it's absolutely critical to distinguish between transformational entrepreneurs and subsistence entrepreneurs. In particular, in emerging markets, you find a lot of subsistence entrepreneurs. They don't find a well-paying job. What do? They open a shop and whatever they sell. You find this in New York City, right? Now, when you look at the statistics, you would find those under entrepreneurs. It's highly misleading. What we are interested in are the transformational entrepreneurs that are innovative and they create jobs, right? So we need to be very, very careful. Now, coming to the financing part. If you want to create a new company, you have a brilliant business idea, what do you do? Well, you may have some savings, right? In fact, quite a few startup entrepreneurs use their credit cards, believe it or not. Now, if you're running out of money, you go to friends and family. That's what you do typically, right? Now, and there are business angels. You can ask for money. There are accelerators, there are angel investors, there are early stage venture capital firms. All of this is being discussed in our course. What kind of capital are angel investors providing? How do you pitch an angel or a venture capital firm? That's what we do in this course, right? Now, and that's really the most critical part here. You are burning cash, right? You have no income, you have no earnings, but you have a lot of expenses. That's precisely when you need external capital to bring in angels, venture capitalists, and so on and so forth. Now, as the company grows, you may get access to both capital funding, you may get access to other sources like even bank loans, or here in particular in the US, it's very important, you can ask for government grants. And then finally, if the company gets more and more mature, you are looking for public equity or private equity and mezzanine financing and so on and so forth. That's beyond what we teach in this course. What we are interested in is really this part here. You have a brilliant business idea, you need funding, what do? Right? That's the most critical part. Now, when you look at this, get an idea how critical funding really is. This is based on surveys. About 50% of companies in emerging economies, some variation across different regions, they find it difficult to get external funding. 50% of the companies. That's a very, very high proportion. So based on World Bank surveys, what do we find? Well, if you go to a bank and ask for money, which would also be a natural thing for you to do, right? Maybe even before you go to a venture capitalist. You go to a bank and you ask for a loan. The bank will tell you in all likelihood, okay, I give you money, but I need collateral. And I need a lot of collateral. Now, almost by definition, if you are a startup entrepreneur, you don't have collateral. Interest rate spreads are extremely high. Interest rates in emerging markets are substantially higher than in developed economies. Guess what? Most companies in emerging markets, on average, are substantially smaller than in developed economies. Why? They don't find the funding to grow. You find a lot of subsidiary entrepreneurs. Their companies, if you can even call them companies, remain very small. Clearly, and I don't want to go through these details, it goes without saying that if you invest in a startup company, that's what we do at Carlyle, that's extremely risky business. Even the best venture capital funds like Sequoia, Kleiner Perkins, and so on and so forth, 60% or so of the companies they back go and end up in bankruptcy. That's very natural. In some funds, the percentage is even higher. And we are talking about venture capital funds that have backed Apple, Microsoft, Google, Amazon, what have you, right? So it's a very risky business. And, I come back to the first presentation. In the US, the regulatory framework is very conducive to, well, I do another startup because I have another idea. In some economies, that's not possible. Now, I don't know whether you can see this, but here you have different income classes in terms of per capita income, starting from very low income countries all the way to highly advanced economies. These are the penetration rates. Venture capital investing relative to GDP. As you can see, it's very, 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 very low. It goes up, right? For the United States, a few other countries in Europe, you have relatively high penetration rates. An exception also, very interesting case is Israel. A lot of venture funding is going on, highly innovative. But here on this side, you have two countries. One is India and one is China. In this course, we try to explain why these countries have managed to get so much more venture capital. And the size is clearly important. But how can you explain that India gets so much more funding than Brazil? Right? Something is going on here which is not very clear from the data. Now, the good news is that in some other parts of the world, venture capital investing is also gaining momentum, including in Africa, in the Middle East, and also in Latin America from a relatively low basis. It takes time. But as you can see, when you compare the early 2000s to the last 4 years, you see that something is going on here. The US market used to be 72%. If you go back to the 1990s, it would have been more like 85%. Now this share has shrunk now to less than 50% as Asia has gained so much more momentum. But when we talk about Asia, what we really mean is China and India. Where do venture capitalists invest in emerging economies? And that's quite interesting when you compare this with the United States. E-commerce, and we heard a few names like Alibaba. I could add Flipkart in India, right? So that's an area where quite a bit of venture capital money is going into it. The other area is mobile apps, and there are plenty of examples. But then also interestingly, Fintech. Fintech receives a lot of venture capital from venture capitalists around the world. These are indigenous venture capital firms, in particular in China and in India, but also US firms that have moved into these economies. We have seen this picture before in the first presentation, unicorns. So clearly, China is absolutely dominant when it comes to the number of unicorns. Followed by India, we have a few in Brazil, but then, you know, there are some which you might not have expected. But for me, that's an indicator that something interesting is going on in these markets as well. There is the possibility for entrepreneurs to be successful. Now, coming back to the regulatory aspect, trying to explain why some countries are so much more successful than others in terms of attracting venture capital. And what is true for venture is also true for angel funding, crowd investing, accelerators, and other forms of entrepreneurial finance. There is an interesting project going on at the European Business School, IESE, based in Barcelona. They have looked at the regulatory landscape, the taxation framework, and so on and so forth, and they have ranked countries in terms of the quality of their entrepreneurial systems. And the results are probably not too surprising. Here in the US, you have a system that's very conducive, generally speaking, to entrepreneurship. Countries where you find relatively limited degrees of penetration generally have problems on several fronts. Now, I think it's an art to set the table. Unless governments make progress on all these different fronts, it's going to be very difficult for entrepreneurs to get funding for their startups. The financial systems, in all likelihood, will remain underdeveloped. It will be tough. There are always exceptions, as you have seen, even in Nigeria, you have a couple of unicorns, but it remains the exception. So countries need to work on all these different fronts that have been identified by this and other studies. Now, the governments can do even more. In fact, a lot of countries have put in place funding systems. The US has been very, very active indeed, but there are a number of other economies that do very similar things. They, in fact, provide funding for startup entrepreneurs. If you go here to the government of New York in Albany, they run at least 2 venture capital funds where you can apply for funding. And other states in the US have similar systems. Then also at the national level, there are funding systems. So that's a very good example for a lot of other economies that have put in place government funding schemes as well. That's it for my side. There's one, but we have covered the fintech already. In this course, we talk a lot about venture, but we will also be talking about in the next spring about angel funding and accelerators and so on and so forth. Thanks very much.
For giving us a taste of what we'll see in this spring. Lourdes, are you?
Yes,
Are you on?
thank you very much. Thank you very much, Peter, Amarildo, for excellent presentations. So intersecting at times and bringing different perspectives of fintech and how technology is changing, and actually technology as a tool for development in emerging markets. Thank you very much. Thank you, Jonathan and Abdullah, for organizing it.